All
You're
right.
on.
Okay. All right. Good. Well, hello, everyone. Thanks for joining. Just to tell you a little bit about me, if you don't know me, I know some of you do, but um, I've been doing this for 27 years, one way or the other. I started out in the 90s and early 2000s working for loan servicers. I ended up working for 4 different loan servicers in 11 different departments. So I kind of saw the whole industry from every different possible angle, both in private and federal student loan operations. And then my career eventually went into the brokerage industry, and I was a trader at Morgan Stanley on the trading desk there for a number of years. But the whole time, even when I worked at Morgan Stanley, I would be helping people with their student loans, no matter what. If I go to my dentist, my brother-in-law, it doesn't matter. 1 out of every 5 American adults has federal student loan debt. So you run into people, and once they find out what you do, they start asking you. Anyways, the demand got so great for the information that I had that I eventually retired from Morgan Stanley, opened up this as my sole focus in 2010, and have been helping people ever since. And in that time, I've given over 40,000 consultations to student loan borrowers on their student loans. And not only with the consultations, but helping them execute their plan too, seeing it through for you. And this is a quick, a fun little note, if you don't know, that before I was a student loan consultant or worked in the student loan industry, I was a professional opera singer.
Oh,
So yeah, so definitely a change in here anyway. So this is my third career. I was an opera singer, then I was a trader, and a securities broker, and then now I'm a student loan consultant
Jan
primarily.
will do a
But
performance for us later.
yes, of course, I know. Yeah, they always ask me, "What, you're going to sing something?" It's been a few years, okay, it's a little rusty. But okay, so what I want to jump into right at the beginning, normally when I do these presentations, I'll often have a more structured overview of what I call the 4 pillars of student loan repayment, which, forgiveness and payment targeting, refinance, and payment acceleration, things of that nature, where you develop an overall strategy. And we can still do some of that, but more importantly, right now, I think given the state of things, the new administration, all of the changes that have happened and that are continuing to happen in student loans, it's difficult to keep up. I can't tell you how many times I've made a video for YouTube, and then the next day something changes, and it's old news, and I have to make another one. And then they never get sent out. So this is hopefully this will serve uh, as a accurate bit of information during this time. But it's been a couple of weeks since we've had any major changes. But I think probably the biggest concern is for a lot of borrowers is the fact that the Trump is trying to cancel the entire U.S. Department of Education. And for people who are relying on forgiveness programs and people who are in the income-driven plans, public service loan forgiveness, and so forth, this is scary. So I often refer to it as my student loan therapy session. So everybody can have their therapy session today, and hopefully you'll be feeling better by the end of it. The first thing the point I want to make about the executive orders to move student loan management from federal student aid directly to the Small Business Administration, the SBA, and the dismantling of the entire U.S. Department of Education. The executive order is against the law. It states clearly in the law that only the uh, federal student aid and the U.S. Department of Education shall oversee student loans. There's no way the Small Business Administration is capable really to have the infrastructure or staffing to deal with federal student aid, even on a limited basis. So it's kind of silly, actually, to think that it would go over there. However, if somehow, and again, it says in Congress-approved law that only federal student aid can oversee student loans. So, and Mohila and Ed Financial and Nelnet and AidVantage, all these companies have contracts to service these loans. So in the end, no matter what happens, your loans will still remain at the same loan servicer you have. I mean, they may transfer to a different loan servicer, but you're going to remain within the student loan servicer system. Your loans are still going to be managed the same way. You'll be still subject to the same rules. On the background, let's say the SBA takes over. They're the ones, just handling a lot of it is oversight that they handle. And then right now, they would probably take on the duties of public service loan forgiveness as well, overseeing that. So what would really happen, what you would see from a borrower perspective, if all that were to happen and the challenges in court aren't successful in stopping that, You would probably just see more delays, I would think. I mean, it's already a very difficult system to work through, and it's really a broken system, the whole thing, of course. But that's just going to make it worse, of course, when you have a institution that doesn't know how to handle federal student loans and the complexity there, handling those. So I think it would slow things down. Public service loan forgiveness is again, a Congress approved program in the statutes, something that you can rely upon. It's going to be there. I always tell people if democracy survives, public service loan forgiveness will survive. So, and I know there's some concern about whether that will happen, but all bets are off, obviously, if we have a dictator. But for as long as the law is upheld on a congressional level, this is not just some small policy. We're talking about Congress approved federal law and the statutes. It clearly states that only the U.S. Department of Education will oversee federal student loans. So I don't know how you could execute an executive order to move it to the SBA and then survive challenges in court, even on a right-leaning Supreme Court. It's so unambiguous. It'll be interesting to see how it unfolds. But in the end, things will remain as they are. Even the Republicans in the Project 2025 and whatnot clearly state that they plan to grandfather in all the existing rules with the exception of the SAVE program. So whatever survives the courts, and we'll talk about, of course, the Eighth Circuit Court and the SAVE, injunction in a minute, but whatever survives the court rulings, even the Republicans have stated that they plan on keeping those intact and grandfathering those in. And then for new borrowers after July of this year, implementing their own plan for those borrowers. But for borrowers already in debt, they should be able to rely on PSLF and the IBR program. The next thing I want to talk about is the income-based repayment program. So, and specifically income-driven repayment plans. And forgive me, I want to do a little bit of teaching on this just because it's very confusing. They're very poorly named, those programs. So the way that it's structured, there are 6 different iterations of the income-driven plans in the last 30-some years. So whenever you hear the term income-driven repayment or IDR, that refers to all 6 iterations, which include income contingent repayment, new and old IBR, pay-as-you-earn, revised pay-as-you-earn, which turned into SAVE. The income contingent repayment plan and the SAVE program and the pay-as-you-earn program and the IBR program are all income-driven plans. And that's why when you recertify for IBR or pay-as-you-earn or whatever program you're in, you get a notice saying your IDR plan was approved. And that always throws people off and say, well, I thought I was in SAVE. No, you are in SAVE. That's an IDR plan. So hopefully that makes more sense. Of those 6 iterations, there are only 2 of them that are Congress approved. I mean, the ICR plan you could count as a third. But the income-based repayment plan, which has a new and an old version. So for old borrowers who've taken out their first loans or maintained debt as of July 1st, 2014 or before, those borrowers are considered old borrowers and qualify under the old terms, which is the 15% 25-year formula. Borrowers who took out their first loans or didn't have debt as of July 1st, 2014 qualify for the new IBR plan, which is similar to pay-as-you-earn. It's a 10% formula. So it's 2/3 the payment of what IBR would be based on the same income. And it's only 20 years for forgiveness. This is, of course, not including public service loan forgiveness. The IBR program is, again, not being challenged in court. It's going to be there. It's unambiguous. It's, again, like PSLF. There's no challenge to that program. The pay-as-you-earn, revised pay-as-you-earn, and SAVE program are all executive actions. They're not in the statutes directly, originally in the Higher Education Act. And those are all based off of the income contingent repayment plan. So when the Republicans challenged the SAVE program in court, they realized the best way to do that is to go right for the source of the original regulations, which have to be not completely explicitly clear that there is actually a forgiveness element after 20 or 25 years. So the forgiveness is not precisely legally stated in there. As a result, it makes all of those programs vulnerable. So as a result, worst case scenario, depending on what the court decides, which it hasn't decided yet, the Eighth Circuit Court, pushed it back to the lower courts, tell you decide what you do with it. And what we expect they did foreshadow the likely ruling that all 4 of them will be canceled, or at least the forgiveness aspect of all of them will be canceled. So the SAVE program almost certainly will be canceled because Trump can cancel that with a wave of his executive order wand. And he said that he wants to do that. We fully expect him to do that if it survives the court, which we don't expect to happen. So there's like a 1% chance of the SAVE program surviving. The other plans, it's possible that they could either be fully canceled or the forgiveness aspect canceled and only still be available to borrowers in public service loan forgiveness, which has its own built-in forgiveness and doesn't require the 20-year forgiveness. So we could see something like that. We don't know. That's just speculation. But the income-based repayment plan, that one can be relied upon. So PSLF and IBR are still there. So what that means is that you still have an opportunity for PSLF forgiveness. However, you just might have a higher payment. You might not, the SAVE program was a very generous payment, a very generous calculation, and you won't take advantage of that. And the older your loans are, the more likely is your payment is going to go up because the programs get worse and worse as you get older, right? You go from 10 to 15% if you took out loans before July 1st of 2014. So if you don't have to worry about SAVE being canceled, that doesn't mean you can't make a qualified payment for public service loan forgiveness. Now, there are some unfortunate circumstances there that will block out a few people who are in the PSLF program now from taking advantage of your final qualified payments, base as it is. Now, I assume they're going to come up with a solution for this, but there are borrowers who only have, 10 or 20 qualified payments or less in PSLF, but their income is too high to qualify to enroll or change into the income-based repayment program. So they qualify for SAVE, but they don't qualify for IBR, which has a payment cap. And if your income is above that threshold, what's called the hardship threshold, which is about equivalent to the 10-year standard repayment and an amortization schedule on your loans. I always tell people, if your income is approaching, and your income on paper is approaching the amount of your debt, and you don't qualify for the new version of IBR, then you get over to IBR as fast as you can, because you may make too much money going forward to actually even change into the plan. And if that's the only plan that's available, you might not qualify for any plan unless they come up with an alternate solution. So just to protect yourself, if your income is approaching that of the amount of debt that you have, if you make 300,000 a year and you owe 300,000, try and switch to IBR as quick as you can to get in there, so that then you're locked in. Once you're enrolled into the income-based repayment plan, then you can make $10 million a year, and the payment will not go above that cap, and you'll still get qualified payments at that point. There's been a pandemic, I don't know if you remember, but we had a pandemic for 44 months of forbearance where you didn't have to make payments. And then after that, you really haven't, in most cases, had to recertify your repayment in any of the income-driven plans. As a result, you might have a payment in IBR or pay-as-you-earn that's based on income that's 5 years old, right? 6 years old, from 2019, maybe even. And as a result, you've gotten used to either zero payments or very low payments. And now you make a lot more money. So when you switch, your payment can increase dramatically. And the anniversary dates keep being pushed forward. So most people don't have to recertify, with the exception of a small group of people right now whose recertification deadline, is before March 31st. So if you had before it was pushed forward, because a lot of people who had an anniversary date before March 31st of this year had already been pushed forward to 2026 or late 2025. But if you still had a recertification date a deadline prior to March 31st, then they're going to make you recertify, which I think is, again, the U.S. Department of Education at its best. I say that ironically. Why make those people recertify and no one else? Everybody else who has recertification dates later than that will be pushed forward into 2026. So nobody's going to have to recertify before February 2026. Except for those small group of people. So if you have a payment due coming in, for example, you have a recertification deadline and your loan servicer is indicating it's time to recertify, and it says if you don't by such and such a date, your payment's going to go up to how many $1,000s a month, then you do need to recertify, and you can process this now on the studentaid.gov. and do that right away to meet that deadline. I always tell people in this circumstance, one of the reasons I bring it up is because you have a lot of people who have been paying $300 a month, and then all of a sudden they say, your current plan expires, and if you don't recertify in 2 weeks, and it's going to be $3,200 or whatever ridiculous amount it is at that point. That happens. Eventually, they're going to correct it, especially if your anniversary date is later, or they should put you in a forbearance eventually if you are going to have your anniversary date extended. Or if they receive an application, they should also put you in a processing forbearance, right? Should is the key word. So as you probably know, MOHELA, Nelnet, all these people cannot be trusted, yes, to actually do their job. So the first thing I always tell people, if you see that happening and pay attention, please turn off your auto pay, because they will debit that account. Even though they're going to correct it in the future, they won't give you credit back for it. So I've already tried to do that for borrowers. In some circumstances you can, but in many circumstances they will not. That 3,400 or whatever the payment is, that's going to be debited, and they're not giving it back, even though they were going to extend the anniversary date afterwards, because they have to do it to all 40 million accounts, right? So it's not going to happen overnight. And this was just an order given by the U.S. Department of Education a week or two ago. So if you have a large payment, take auto pay off. Now, remember, you can let the account go past due for up to 90 days before you're reported to credit. So I always tell people, let it go 30 or 40 or 50 past due. There's no late fees, no reporting to credit, no consequences. It's not fun to do that, of course, but you're going to give the loan servicer time to fix it and put extend your anniversary date if it applies, and sort it out, or put you into forbearance if you've submitted an application. Now, if they don't, if you start getting closer to 60 days past due plus, you certainly don't want to flirt with the credit reporting. So then you want to put the loans in forbearance, which is actually quite easy to do with Nelnet, Aidvantage, and Ed Financial. You can call them, or you can do it online. Calling them will put it in the correct processing forbearance. But MOHELA, they have something like a 5-hour hold just to get a hold of them right now. So you might have more difficulty doing that. Now you can choose the callback feature, and then maybe if you're around in 5 hours, if they do call back, you'll be there to field it, but it might be a lot more difficult to do that. So be prepared for that lengthy process, but it's going to be worth the effort. Just because obviously you don't want to have to pay the larger payment, and it'll get sorted out one way or the other. Either eventually you'll be put in a processing forbearance, and then someday they'll process the actual income-driven plan recertification, which they're still not processing now. And there's like a 7-month backlog, so it's not going to happen anytime soon. Anybody who has an application in that they put in recently for an income-driven plan of any kind, don't expect that to process any time in the near future. So just be aware of that. That's kind of a thing I'm seeing happen with some of my clients is, oh my gosh, I got debited for $2,200 and I can't afford that. And, so I'm trying to tell everybody I can, turn off auto pay if you're in an income-driven plan and they haven't advanced your anniversary date yet, or if they're asking for recertification, just to prevent that from happening before the processing gets done, which is delayed. So anyway, it says that. So I want to make sure I got that message out there. So the next question is going to be, and a lot of especially the public service loan forgiveness borrowers are going to have these questions. And that is, I'm in the SAVE program. How do I get out? Right? Because the SAVE program is in the court injunction right now. You have a 0 payment, 0 interest, but none of that's counting towards PSLF in the real time, right? Now, there is the buyback program, and we can talk about that, a promise in the future that you may be able to buy back those payments. And in fact, I've had clients successfully do that early on, but that program's bogged down now a little bit. So it's, the processing isn't as quick and snappy as it's been. And we'll talk about the buyback program. But ultimately, you want to get out of SAVE because you're going to have to get out of it eventually anyways, because it's going to be canceled. And you want to get into a program that's giving you real-time credit towards PSLF. And they'll allow you to, if you qualify for it, apply for the pay-as-you-earn program, but you can also go into the income-based repayment program. Now, if you're in that situation, you're going to want to submit a request to switch your plan as fast as you can. And which plan to choose you have a couple options, but let me put it this way. If you are a new borrower who's taken out loans after July 1st, 2014, in other words, you weren't in debt before that day, then definitely you want to choose IBR, because IBR in that circumstance is just as good as pay as you earn. In fact, it's better because it's a grandfathered Congress approved plan, which pay as you earn is not. So that program is going to stay where you could actually switch to pay as you earn, and 2 months later, the courts could take it away from you. If you don't qualify for new IBR, then there could be a temptation to apply for pay as you earn, because it's a 2/3 the payment of what IBR would be in for older borrowers who've taken out their first loans before July 1st of 2014 or held debt as of that time. So those borrowers, instead of 1,500, your payment's 1,000, right? It's a big difference. So those borrowers may be tempted to do pay as you earn, which, okay, you could do, and it's not a bad idea. But if you want to be absolutely sure you're getting a program that qualifies for PSLF, probably a good idea just to go to IBR anyways, pay the extra if you can afford it, to lock yourself into a plan that's not going away, that is, that qualifies for PSLF in real time, that is going to survive the court and even survive this administration. So that's, if you don't want to mess around, especially if you're towards the end and you only have less than a year of qualified payments or something like that, you might as well, if you're not in a hurry and you've got 6 years left before you get forgiven, sure, stay in the save injunction forbearance for now. Enjoy the $0, save the extra cash, do what you got to do. Just know that you're not getting credit towards PSLF, and the buyback program is not something that you can wholeheartedly rely on. So let me talk about the buyback program a little bit. The buyback program, if you don't know what that is only for PSLF borrowers, and that allows you to buy back all of the payments, all these months that you were in the save injunction forbearance at the IBR rate, right? So you have to pay a lump sum of the amount of what your monthly payment would have been under IBR during the time period you're buying back. And you can't even request the buyback program until the months that you're buying back bring you to 120 qualified payments. So you got to have 10 years in working for nonprofit minimum before that's ready. So if you have 5 years left, if you only have 60 qualified certified PSLF payments, you have to wait until, with the buyback, it'll bring you to 120. So you got 5 years left or so, 4 or 5 years before you can even apply for the buyback program. So we're not even going to know whether or not that program is going to exist at that time, because that program, also the buyback program, was created and instituted during Biden administration via executive action or negotiated rulemaking. It's not directly in the original statutes. As a result, again, they could cancel it if they want to. It's a more lesser known program, so I could see them not canceling it and have bigger fish to fry, and maybe not realizing it's even there. I don't know how detailed the new administration will get by that, but and then it's also possible that if you're going to be forgiven in the next administration, I always joke and say that, when Taylor Swift is president in 2029, which I'm almost certain that she will be by that time, she will, reinstate the buyback program, likely. If any Democrat actually is elected, that program there's a good chance it could be reinstated, and there's a good chance that Trump might not even cancel it. So there's a strong chance it may exist, but you don't know that for sure, so you don't want to rely on it. That's why I recommend switching the plan, get into a real-time payment as soon as you can, as long as you can afford the payment. Also, a question I get too is, I'm in the save injunction forbearance, and I'm not, should I pay anyways? Can I pay something, an amount? Don't pay anything. It doesn't matter what you pay, it's not going to count. So you've got to be in a qualified plan. You got to make a payment that's established on your billing cycle in a qualified plan. That's what's going to count towards PSLF. So don't make payments if you're pursuing public service loan forgiveness, and you're going to continue to do that through to the end. Don't make any payments right now, because they're not counting towards PSLF anyway. So I have a lot of people I talk to say they're making payments. Oh, the other thing too is that the federal student aid is sending out this notice saying, I'm getting this notice saying you're delinquent or you're in danger of default, and like the world's going to end. And it's coming. It's kind of people are getting it who aren't even past due. It's kind of just a canned response. It's going out to everybody, an automated response. Check your loan servicer. If the account's current, you're good. Always, when it comes to payments due, ignore federal student aid. They don't know what's going on. So that's just what they're doing. The reason they put that letter out is because up until recently, due to the pandemic, they were not reporting to credit when you're past due. They had this on-ramp thing going on, and they were extending all these anniversary dates. Now they're starting to report to credit. So they're sending this notice out, letting people know, hey, we're going to report to credit if you're past due. But instead of saying it like that, they just went, you're past due. That's how the U.S. Department of Education thinks. They like to scare the heck out of you, basically. As you know, they use the worst language possible. Here it is. So there's a question that says, I managed to successfully complete double consolidation and then put in a paper application to join the SAVE program back in April 2024 before it was processed, and the whole SAVE program ran into troubles and the court suspended. I'm extending forbearance every 2 months ever since. I'm not sure when any affordable payments will start. Any idea, suggestion? Okay, so for this is a good question. So for those of you who don't know, we're doing the double consolidation, and I won't get too detailed with that unless you want me to, but basically this is for Parent Plus borrowers. And Parent Plus borrowers do not qualify for, if you remember those 6 different iterations of the income-driven plans, they only qualify if they have a consolidation loan with Parent Plus loans in it. They qualify for just the ICR plan. Parent loans by themselves qualify for none of the plans. However, there is this loophole where you can consolidate consolidation loans, and the consolidation loan that contains consolidation loans, that contains parent loans, qualifies for all of the income driven plans, right? So it's a way around it. So borrowers are doing these multiple consolidations to get access to the SAVE program or any of the income driven plans on parent loans, which otherwise wouldn't be available. So that's what this borrower did here. So with the double consolidation, you have to have a time-stamped application in the queue at your loan servicer before July 1st of 2025 of this year. Otherwise, the double consolidation kind of ends there. There's kind of an interesting thing, actually, if they completely cancel the whole SAVE regulation, the closing of the double consolidation loophole is also in that regulation. It could actually eliminate the deadline, but we can't depend on that. So what I would do if I were this person is, if you submit in April 2024 to your loan servicer, did you get notification that they received it? And number 2, you're not going to get in the SAVE program. SAVE is going to be canceled. So what I would do, just to make sure you have a time-stamped receive form by your loan servicer, is I would do another application request online and do income-based repayment, just to make sure that you get, again, locked into a plan that's going to be there. Because IBR is still a much better plan than the income contingent repayment plan. You're still benefiting from the double consolidation, and you're still for sure making the deadline. So for this person, they have the SAVE application, but if SAVE's canceled and they get the application, will they automatically put you another one, or will they just say you're declined? So instead of taking that risk, send in a new app for income-based repayments. Get it timestamped before July 1st.
Basically, you're saying, and not to oversimplify, if you're in the SAVE forbearance, you're saying ditch it, go IBR.
Exactly. And for this person, they never got into SAVE, right? So she put in her paper application in April of 24, and they were still backlogged at that time. So by the time the loan servicer got to it, boom, the injunction happened, the court injunction. So they stopped processing income-driven plans from that point on, really. Until present, with the exception of a couple of weeks this year. So their SAVE never got instituted, never got approved, right? So it's still sitting out there, floating out into space somewhere. So they're technically not in any income-driven plan. And they're just using forbearance until it finally processes. And it depends on whether they, obviously if it's a processing forbearance, like let's say, the loans, if the loan servicer is doing the forbearance themselves, it says awaiting administrative forbearance or for approved form, something like that, then that probably means that they have received your SAVE application. But again, if SAVE goes away and you specifically applied for SAVE on that income-driven plan application, why not be better safe than sorry? Send in another app, get it time-stamped for IBR. That's what I would do, just to make sure that I meet that deadline. Yeah, so here's a basic question here from Evan. Will we still be able to have government consolidation of direct loans? Yes, that's not going away. Again, that's there's no plans on getting rid of that. Again, that's part of the original statutes. Federal consolidation is so something that they'll always have in place. So I do not expect the regular federal student loan consolidation process to go away. And a quick note on forgiveness, and this is important, a note I want to let everybody know. Even though when you hit 300 qualified payments or 120 qualified payments for PSLF, even though the forgiveness is not going to happen like that, and this administration is going to take a while to process that, payments stop. So you can stop making payments the moment you hit the maturity of the program. So you may have to wait a year before you get forgiven, depending on how long it takes to do that. But you will stop making payments forever until it is forgiven, and you'll be basically in perpetual forbearance at that point. I am still seeing borrowers forgiven every other day. So as recent as yesterday and a week ago, borrowers that are members of my, there are clients of mine, watch their balance turn to zero. That wasn't supposed to happen. They put a 90-day hold in March on forgiveness, but they're still getting forgiven. So forgiveness is still happening. Employment certifications are still processing. The system is still working.
Just to focus something, let's say for
Yeah.
older borrowers,
Yeah.
non-PSLF, they're on safe forbearance. So should they
Mhm.
switch now and apply for an IBR? Or
Right. So yeah, it's
Okay.
kind of the same answer, right? So in other words, it's yes, you're going to have to switch anyways.
Okay.
But before you do so, number one, know what your payment's going to be, right? Because there's a lot of people sitting there with $100 to $200 payments that now make $100,000 a year, and in old IBR, that's $1,000 a month, family size one.
$1,000 a month, right.
So they may get the sticker shock, right, when the payment comes through. So be aware, do the math on that, or again, find out, seek out help, with people like me or consultants that can run all those scenarios for you and those numbers. But of course, there are, repayment calculators you can use for IBR online that will be generally give you a basic idea what to expect. But yeah, so I would say, again, I have clients who they're like, you know what, I'm just enjoying the 0% right now because I'll get forgiven someday, but if I could use the zero payment right now. When payments start up, they're going to be kind of expensive. So I have other things to take care of, other priorities. Absolutely. But if you're in a hurry to get forgiven, then it's really a personal choice. Again, with PSLF, the circumstances where I would recommend no matter what switch are you're in public service loan forgiveness, just get out of SAVE and get an IBR, start getting those payments as quick as you can. Number two, if your income is approaching the amount of debt that you have, or it's going to eventually eclipse that, get into IBR because that might be the only program available, and you might not be able to get into any plan. Theoretically, it's possible that you could, after the court decides and cancels half of the plans, there might not be a plan that you qualify remaining that that you can get into that'll finish out the forgiveness. And if they don't have an alternate solution for that, like bringing a new program or allowing an exception or something like that, which is not as easy as it sounds, then you're stuck and you're kind of left out in the cold there. So if your income is approaching the amount of debt you have, this is a general solution, even close to it. If you have $100,000 in debt and your income is popping up to 90, 95, 100,000, okay, you need to think about going to IBR, because if it keeps going up, eventually you can't get into IBR. And if that's the only program that's left, what are you going to do? And so what happens if you use the other payment plans, Save and Pay As You Earn, and had them PSLF programs, where these payment plans still count? Yes, you keep what you've earned, and that's whether it's PSLF or not. So whatever qualified payments you have from the past, you're going to keep. And even if you were not to do PSLF, you still keep what you've earned. So you could literally start out in income contingent repayment, 10 years ago, switch to income-based repayment, then switch to revised Pay As You Earn, and then get switched to SAVE. You'll get credit for all the qualified months that overlap that entire time period. You pick up where you left off. You never lose what you've already accrued.
The difference between PSLF and just forgiveness, because I think sometimes
Yeah.
there's a confusion on that. Could you go over
Yeah.
that real quickly? Yeah.
That's a good idea. So yeah, so all the income-driven plans have their own built-in forgiveness, right? And it's either 20 or 25 years long. So for borrowers who have grad debt and their loans are older than July 1st of 2014, it's 25 years in every circumstance. Because save would be 25 years, repay would be 25 years, and IBR would be 25 years. They don't qualify for, well, they would qualify for pay as you earn. Now, pay as you earn is a 20-year program, and you can't have loans older than October 1st, 2007 for that one. Ultimately, they have their own built-in forgiveness, either 20 or 25 years, depending on the plan. Now, the income-driven plans also create a qualified payment for public service loan forgiveness. Then that forgives after 10 years of overlapping eligible payments. So the qualified payment, so you actually get dual credit, right, when you're in an income-driven plan. Let's say you're in pay as you earn, right, going towards the 20-year forgiveness. Every payment you make, a qualified payment you make in pay as you earn, counts towards the 20-year forgiveness. If that payment overlaps the time period you're working at least 30 hours a week for a nonprofit or government agency, or a combination thereof of multiple employers, will count towards the PSLF 10-year forgiveness, right? So there are actually people, I have clients who are on pace to get forgiven in the 25-year plan before they get 10 years in PSLF. And that's because they started working for nonprofit like 15 years into repayment. So they've already got 15 years of qualified payments towards IBR or whichever program. And they have to do a full 10 years in PSLF from the point they start working at the nonprofit. And I have some of them on pace to be forgiven in income-based repayment before they'll get 10 years in PSLF. So you're getting simultaneous credit for both programs while you're in both of them. It's just that you'll get forgiven quicker if you're doing PSLF because you'll get after 10 years in most cases.
I'm not sure if you already
Let's see.
answered this. I'm
Yeah,
sorry.
go ahead.
But just to add on, so if you're in forbearance, that's not counting towards the 10 years, even if you're working
No.
for a nonprofit or
Right. So
just
let me clarify,
it's
because
pushing it out.
yeah.
So like if you're
Yeah.
making just a little bit the first year and you're on forbearance, then you're actually going to end up paying more because the next 10 years after that'll be higher salaries.
That's right. Exactly. Because if you're on an ascending income growth trajectory, then your payment will be a little bit higher, right?
So if you expect your
based
income
on
to
that.
jump a lot, you should get out of the forbearance.
Well, if you can, right? So, and it depends on the forbearance. So this, again, is never an easy answer. So the save injunction forbearance does not count towards PSLF in real time. We're talking about PSLF, right? So if we're talking about PSLF, the save injunction forbearance doesn't count. However, if you put in a plan request switch, once they receive the documentation shortly after, they're supposed to, if they do the job, put you in a processing forbearance for 60 days. The processing forbearance does count towards PSLF for 60 days, which might overlap 3 months, right? Think of it, let's say it's May 15th through July 15th. That covers May, June, and July, even though it's only 60 days. But then after that, it goes into a general forbearance, which does not, right? So until they actually process it. And because it's going to take longer than 60 days for them to process that switch, you'll get credit for 3 extra months, but then you'll still have to buy back any other additional months you're in forbearance. The forbearance you're in now with the save injunction does not count. That needs to be clear. In real time, you can maybe buy it back in the future. But again, that's if Trump doesn't cancel it. The buyback program is an executive action. So it's not in the original statute. So Trump could cancel it if he wanted to, or the new administration could. That's not being challenged in court. So if they don't cancel it, they won't cancel it. Maybe they won't get around
Let's
to
not
it.
tell him about it. Maybe he'll never find out.
Yes, exactly. Although I know that, that I'm sure that one of Trump's administrative individuals is on this call probably, but hopefully we can mute me out for that. But yeah, so again, yeah, so the you may be able to buy back these months. And again, I've already had clients successfully buy back and get forgiven. Now, these are rare circumstances where they're at already 119 qualified payments. They only need 1 or 2 more. So for a buyback, you have to first do another employment certification, and then you have to do the buyback request. And then they send you the amount that you have to pay. You pay it, and then they bring you to 120, and then you're forgiven. That process is at least 6 months long. It's
But
like
if you
think
were
about a
in,
month for every step.
if you did like the 3 months that you said is basically forgiven, and then another year, let's say, since then,
Mhm.
then like after 9 years now into a plan, can you ask for the buyback of that previous year that was in forbearance?
Anytime you were in the
So you
same
can do it
injunction
in a year
forbearance.
in advance instead of, you said, like a month in advance.
Well, no, so for the buyback program, you can't even use the buyback program until the months that you're buying back bring you to 120 payments. So it's a silly rule. I didn't make the rule, but it's the buyback rule. And that is, so let's say, for example, you have 110 certified qualified payments on the tracker at studentaid.gov with the green bars and everything, right? And you've been in the save injunction forbearance for 9 months. You can't apply for buyback yet. So, but on the 10th month, you can, right? Because now you've got 10 buyback months plus the 110 you've already got certified.
Exactly.
So if you
Okay,
get
great.
yeah, check to see, you can go on your tracker and see how many payments are ineligible and how many are actually employment not certified. And you'll be able to buy back any of the ineligible loans or loans that don't show up on the.
PSLF counts toward the Parent Plus?
If the Parent Plus loans are consolidated, yeah, yes, it does. Yes, it does.
Just to
But,
clarify what
they're-
that buyback means, Jan. So you
Yeah.
said you could, let's say you could buy back those 9 months. So then you would
Yeah.
take the income you made in those previous 9 months, 10 years ago or whatever, and that's what they would base it off of. So you're making like 100,000 back then, but then you're making 300,000 10 years later.
Right.
You'd pay, the buyback would be based on the old income?
Right. So that's a good question. So if the buyback is less than 12 months, yes. If it's over 12 months, the rule is that they're going to ask for more recent proof of income for that time period. So you might have to provide a 2023 tax return or something like that.
So hold on to
So
the tax
that's-
returns for 10 years.
Oh yeah, hold on to your tax returns, exactly. And they may ask for, again, proof of income if the buyback is over 12 months or more. So be ready for that. And then they'll send you, so this is the way the process works, just again to go over it, because once you hit 120 payments with the buyback, right? So the months you worked, you got 110 qualified in the scenario, and you've got 10 to buy back. Then you have to first submit in a new employment certification form to cover all that time period up to the very day that you submit it, right? To the very month that you're including on the final buyback. You have to wait for that employment certification to get approved. You'll still be at 110 because it's all ineligible right now. Then you have to submit a buyback request. And if you Google FSA space buyback, you can find the instructions in there. The easiest way to find it. And then once you submit the buyback request, you'll get a notice a couple of weeks later saying, we have a case number for you. We'll get to it, right? And then about a month or two later, you'll get a notice saying your buyback has been approved. You have to pay $39,250 billion to buy back these loans, whatever it is, right? 10 times the amount of the qualified payment based on the proof of income that's used. And under the IBR formula, not the SAVE formula. And then you'll pay it per instruction, and then they'll receive it. Then they'll bump you to 120, and then you'll be in the queue for forgiveness, which usually happens 2 to 4 months later. But given the new administration, that could be 2 to 4 years. Who knows? But payments will stop once you get to 120. You can stop making payments. That might not happen automatically, by the way. You may have to call the loan servicer and say, "Hey, I'm at 120. Put me in forbearance." But I don't know if you ever noticed the employment certification form, but it actually click here. If you think you're at 120 and you want to go into forbearance, it actually gives you that option. If you check that box, that doesn't mean MOHELA is going to do it or your loan service can do it. So you might have to follow up on it. If you have a payment due after you're at 120, call them up and make them fix it.
I know people are asking about the processing time. It is around 6 to 8 months, isn't it? I mean, I'm hearing
Oh,
February to
yeah.
September 2026. That's the
Remember, since July of 2024 to present, they've only processed income-driven plans for 2 weeks. And this was sometime in January. So they started in 2 weeks, and then the new administration took over and stopped it right again. So we've
in
got
the
like a
interim-
7-8 month backlog. Yeah.
So in the interim, what is happening? Let's say, for example, if someone is saying your payment due is 0, then it's 0.
Right. If your qualified payment is 0, it's 0. But if you're in the SAVE injunction, it's 0 and it doesn't count. Right.
Okay.
Yeah. So the
Okay.
SAVE injunction
It
doesn't
doesn't count.
matter. Yeah. If your payment was 0, you're still not getting credit.
No credit.
But the
on that one.
buyback would be easy for them. Like, let's say under the IBR, let's say you make $15,000 a year, right? And your payment's 0 in SAVE, it would have been 0 in IBR as well. So that when you go to buy it back, and if it's less than 12 months, they'll use that proof of income and they'll automatically get the buyback in that circumstance. So lucky you. But most people's income has increased quite a bit from what I usually see. But everybody's got their own unique situation, right? Everything's a snowflake. Does the loan consolidation set a new origination date, especially with respect to the old and new IBR? No. So when it used to be before the pandemic, when you did a federal consolidation, it started you from ground zero. And then you had to apply for a new income driven plan. And then when that was approved, your anniversary date would be based on that origination date of the new plan, right? So it would change your plan then. When you can, and then you didn't get credit for anything in the past, you're starting from zero qualified payments. Then they changed that rule and they said, okay, we're going to give people credit. And through the IDR one-time account adjustment, we're going to give you credit for any month, any loan, including the consolidation, was in repayment of any status at all. Even some forbearance periods would count and give you credit for all that. It's very generous. And a lot of people were forgiven under that rule. And then that ended last year. And now when you consolidate, then they take a weighted average of your qualified payments based on balance from the loans included in the consolidation. But every time you consolidate, no matter what the circumstance or when you do it, you have to apply for a new income driven plan. And it establishes a new anniversary date. So the answer to the question is, that's a long answer. The answer is yes. It changes the anniversary date, but it doesn't change your qualified payment total now. You still keep the payments that you made.
Can I ask about the buyback a little bit more?
Yeah.
So my interest was piqued when you all of a sudden said that if your payments have been zero, then that's what would be calculated. And because I've been living overseas, my payments have been zero.
Foreign income
for
tax
the
exclusion,
past,
right?
Yeah,
Yeah.
exactly, for the past 12 years. Now I'm recently here. I'm on the Save Forbearance, and I will start working shortly, which means my income will jump. But is there kind of a maximum amount of month? Like if I have 8 years until forgiveness, can I buy back 8 years at my $0 payment rate?
No, I mean, again, so you can get credit for the stuff in the past through the IDR one-time account adjustment. But as far as buyback goes, which is something different, buyback only applies to a qualifying time period, and the save injunction forbearance is one of those qualified statuses that can be bought
I
back.
see. Okay.
But let's say you were in forbearance for 4 years before, any forbearance periods prior to basically August of last year, any forbearance periods 12 months in a row or more, you'll get credit. Those will be eligible months for PSLF, not because of buyback, but automatically due to the IDR one-time account adjustment, which is
buyback is only for PSLF. It's not for.
Yes, buyback's only for
Okay,
PSLF,
okay,
correct.
okay.
Yeah. So you can't buy back without PSLF. The regular income driven plans don't have buyback, but you will get credit for time period in forbearance or zero payments you made in an IDR based on your low adjusted gross income. What I would recommend to you, have you filed your 24 taxes yet?
No.
Don't do an extension,
Yeah,
because you
I
can
am
still use your
actually.
23 return, right? Use your
Right.
23 when they do make you recertify. You can use either the prior 2 year, whichever is most recent. So if the 23 is the last one you filed, that one will still be low because it'll show low AGI based on your overseas. And for those who don't know, when you're overseas, I think it's 120,000 now. You can have up to 120,000 deducted from your adjusted gross income in US. So let's say you make 150,000 US equivalent and you live in Spain for over 180 days. Then when they do your taxes, your US taxes, they will subtract 120,000 off of that. They'll do the adjustment. So your AGI will only be like 30 grand, which would create a payment of almost nothing, if not zero, depending on your family size. So that's what her situation is here. She was overseas, so her payment was super low because her income on paper was very low. So it's going to go up on paper once you start working in the US, and you want to make sure that you milk that low income from the older tax returns as long as possible.
So would the idea be, because I'm on Save and it will be disappearing, to go onto, I have very old loans. So the idea would be to go onto IBR with my 2023 tax returns, basically. That's the idea.
Right.
Okay.
So you go to IBR, and it's going to ask you, because right now, even if it was working, it would be fine. But the IRS link, how it used to be where you provide approval and then it would automatically, that's just not working now. It's going to ask you to upload a document. So you'll choose, for example, let's say you're going to switch to IBR, right? Or you're going to try and recertify IBR. You'll go into studentaid.gov, you'll hover your mouse over the loan repayment tab, click on income driven repayment plans, and then you'll click either apply or manage my plan if you want to switch or recalculate. And then you'll go through the process, are you single, are you married? Do you have taxable income, blah, blah, blah. And then it's going to ask you for proof of income, at which point you can then upload your IRS form 1040 from your 23 return. And they'll base your payment off of the proof of income on line 11 of your 2023 1040.
So that IBR plan would be the best thing for this, or the only thing really for this situation.
Yeah, really. I mean, to switch again, you could choose. When did you take out your loans? How old are they?
I consolidated
So
for
when
the
did you take
save.
out the original debt?
So the original one would have been like in 2001 to 2005 or something.
Yeah, so you don't qualify for pay-as-you-earn or new IBR in that circumstance because your loans predate October 1st, 2007. And you had debt as of October 1st, 2007 and July 1st of 2014. So IBR is your only option. I mean, if the income contingent repayment plan survives, you could do that, but that would be a gigantic payment because that one, that one would be a bigger payment. It's a 20% formula, so you want to avoid that if you can. Is your income as much as your debt?
My income, initially it will be about 20,000 less than my debt.
Okay, good. So you want to get into IBR for sure. Switch to IBR with your 23 return, and that way you can make all the money you want and you don't have to worry about being kicked out of that program at that point.
And that still contains forgiveness.
Yes, after 25 years.
There's this one question, because I think sometimes when you mention student aid can make things confusing.
Right.
They don't call any plan IBR, because I think I know the answer to this. Is IBR the standard repayment plan, which it isn't? No.
No,
right?
Income-based repayment is one of the 6 iterations of the income-driven plans.
So what is going on with student aid? Why don't they have it? Did they remove the IBR option?
No, the IBR option is available both on paper application and online. Yeah, in fact, it's the top option. It's the SAVE program that's been removed, but IBR, ICR, and pay-as-you-earn are still available on there. So you could choose pay-as-you-earn if you qualify for it. But again, my recommendation is, especially if you're in a situation where you have to make sure you get in a qualified plan before your income gets too high, choose IBR, take the higher payment. Pay-as-you-earn survives and you qualify for it, you can switch to that later next year if you want to. If I don't think it'll survive because the courts have kind of implied that it's not going to. But if it does, again, there may be a circumstance, for example, where they let borrowers in public service loan forgiveness use the pay-as-you-earn program to create the payment for the PSLF forgiveness, but get rid of the 20-year forgiveness inherent in the pay-as-you-earn program. That's just one of many examples. But if you need to get back into it, you will be able to apply for that. I've had many borrowers tell me, I talked to my loan servicer and they said, I can't apply for pay-as-you-earn in the future, even if it gets, that's not true. You can apply for any plan that you qualify for. So, and I mean, it used to be that pay-as-you-earn was no longer an option because of the SAVE program, but that's being wiped out. So pay-as-you-earn will once again be available to people. So you could choose IBR, get into IBR to make sure that you're for sure safe. And then later on, if pay-as-you-earn survives the courts and Trump doesn't cancel it and it stays around, you can switch back to that if you want to.
I have a question in terms of the income. Your income has to be lower than your loan for you to qualify for the IBR. Is that what I understood from you?
That's an estimation. So the formula for income-based repayment is complex, right? It's based on your proof of income, and basically they'll take in your family size, right? So let me give you an example. Let's say you have, and let me ask you real quick, just as a round figure with the nearest 20,000, how much debt do you have?
Over 300,000.
And what's your family size?
Just one.
Okay, that makes it easier. Okay, good. So I think, no, I'm married, have 4 kids, and I live in a common property state. That would have been a much more complicated answer. Okay, so the way they would calculate your payment, let's say your income is $270,000 a year, and I'll use my calculator here just to give you precise figures. 1 second. So let's say you make $270,000 a year. The way they calculate the payment in IBR is they'll take $270,000, they'll subtract 150% of the poverty line in your state, which for family size 1 is 23,000 approximately. They'll take that figure, which is 247,000 times 15%, and then they will divide it by 12, and that comes out to 3,087 50. So the 3,087.50 would be your qualified payment. Now, 300,000, the cap to get into IBR, your payment has to be less than the 10-year standard equivalent, based on when you originally started the program, by the way, and not what your balance is now, to qualify. So let's say you have a $300,000 loan, probably at 7%, right? That's going to create a payment of like 3,500 in that range, 3,400, something like that, on an amortization schedule, if that's what your balance was at the time. But your balance might be 300,000 now, but it might have been only 240 when you first started the program, when you first finished school, right? So you would need to base it off of that. So as long as your qualified payment based on your income in the IBR formula creates a payment less than what the 10-year standard would be based on your original loan balance. I know that's just saying it did melt your brain, right? Then you'll qualify. So you're at the threshold, right? Depending on exactly what your original balance was and what your interest rate is. My expectation is that you would still qualify for IBR, but barely. So you'd want to get in there quick. Did that cause more confusion? Yeah.
No, no, it's actually very helpful. So
Okay.
it would be a better strategy to switch from SAVE to IBR now, as opposed to waiting until they switch me themselves. And
You're the
then
prime example of that. Absolutely. Your income is approaching your debt, right? You have 300,000. What is it you make?
I make under 100 right now.
Okay, then you're fine. So if you make under 100 right now, is your income going to grow strong, or what is it you do for a living?
Yeah, I'm a resident right now. Once I become
Okay.
an attending and finish my training, it'll jump quite a bit.
Yeah.
So
But it's going to take a long time, right? You
yeah, like
guys always
3
change
years.
position middle of the year. Yeah, exactly. And then the year after you're an attending, your tax return still shows your training salary. And then the
Right.
year after that, you show half the year as a resident or fellow and half the year as an attending, right? So it takes,
All right.
I call it the doctor's loophole, where they're like, some of my radiologists are like in year 9 before their payment goes up to match their income. But and then if you're doing ER emergency stuff, you only have 3 years, right? And then you have 7 years at your high, or at least 6 anyways. But anyways, yeah. So in your case, especially if only IBR survives, you have time right now, but you'll want to get into IBR before that's the only program remaining, before your income increases at your attending salary. Now, you've got time. So in 1 or 2 years, we're going to know whether pay as you earn or any of these other programs are going to be available. So, you're not in any super hurry, but eventually you're going to want to switch over to IBR, or at least get out of SAVE.
Okay, and I'm assuming that even in a year from now, we're probably gonna have like no SAVE plan for sure and have a better
Definitely
idea.
not.
So they're gonna switch me out before I even make the jump myself.
Right. If you
I
just
stay here.
wait where you're at now, they'll eventually just make you go into the next plan, most likely. So I don't know if you remember for those people in repay who automatically switched to SWAVE, they just automatically switched you, right? But that's because
Yes.
they were kind of one and the same plan. They'll actually be changing your plan, and I suspect they'll give you the option to say, hey, do you want us just to put you in the next best available plan automatically? Yes. Okay. And they'll do it for you. Or they may make you do a full switch application online and switch programs. We don't know yet. But because if you were an attending right now, and for 2 years in, you're like, my last income was, half attending, half resident, and I made 220,000 and I have $300,000 in debt, I'd be like, switch immediately, like right now. But because you have a couple of years, you can kind of hold on if you want and wait to see how it all unfolds.
Okay, and I could still eventually possibly use the buyback program to buy those years that I was on SAVE, but not really like on the forbearance.
Right. Yeah. So again, yeah, you can buy those back. Again, like I said, you can't depend on that. So that's why I'm telling people, get over if you're in a hurry. And like in your case too, think of it this way. If buyback doesn't work, then you're going to have to pay an extra year worth of payments on the back end with your attending salary.
Yeah.
Your proof
So
of
it's kind
income,
of a
right?
gamble, isn't it?
It's a bit of a gamble for you. Yeah.
Okay. Thank you so much.
Now, Jan,
Mhm.
when you're changing your payment, your plan, and you're in forbearance, does it take your loan out of forbearance? What?
Yes, so they actually give you that option. So on the application, especially if you do it online, you'll notice the system will say, we notice that you're in forbearance. Do you want us to cancel the forbearance and put you into the new plan upon processing the request, or do you want to stay in forbearance while you're in the new plan is created? You actually have the option. So I
You
tell
have the
most people to
option.
say, by the way, which is unbelievable and typical of the U.S. Department of Education, on the paper application, you answer yes, take my loan out of forbearance. On the online one, you say no, cancel my forbearance. So it's a yes on one, a no on the other, but you're basically saying the same thing. You want forbearance to be canceled, and it won't be canceled until they actually process the request. So when you submit it online, you say no, cancel my deferment upon approval, you'll still be in forbearance for several months while they process. And then once they do process, then you'll start your new payment on the new
Then the
approved
new payment
IDR
kicks in.
request.
So you can't
Yeah.
really just have the new, so basically your relief time, if you will, would be the processing time.
Right.
Okay.
Yeah, exactly.
Okay.
Can you speak
Can
more
you
about
use the,
Oh, go ahead.
Go ahead.
oh, thanks. I'll be quick. I was just asking, when you're processing your payment now, since it's tax season, or processing like an application now because it's tax season,
Mhm.
can you still use a 2023 tax form, or do you need
If
to
you haven't filed
extend?
24, right? So you
Okay.
haven't filed
But like
24,
if I
you can
haven't
still use your 23.
physically filed it yet, but I haven't filed for an
Right, you can still
extension.
use your 23. Once you
Okay.
file it,
Okay.
then that you have to use the 24. Exactly.
But you
So
don't need
a
to
lot
file
of
for
people
an
do that.
extension if you don't.
No, if you haven't
Okay.
filed it yet, you do not have to do an extension.
Okay.
Can you speak more about the pay plan? And I know if we're on the save plan, we should switch over, but if we're on the pay plan and making low payments and don't have to recertify until next year. But like for
Mhm.
me, my income is now significantly higher than my loan amount. I don't even know if if I'd qualify for IBR. Should I do that now or
Have you filed 24 yet?
not yet?
Are you single or married?
Single.
So I love single people. I always tell people I should charge married borrowers 4 times as much because your situation is very complicated. So I'm sorry, all the married people out there. Give me a ballpark. How much you owe?
Around 50.
And what's your income approximately now?
It was, I think last year 90 and
Okay.
now it's around 110, expected to be around 120 or 25 next
Right.
year.
And what years did you take out your first loan?
Before 2014.
Okay, so yeah, so you don't qualify for IBR. What's your family size? Does anybody else live with you?
No.
Okay, so go find a couple bums off the street, move in, create a family size. So here's a quick thing I'll say on family size real quick. A lot of people don't realize the rules for family size for the income-driven plans are different than that of the IRS in some ways. So for example, unborn children count. So if you're expecting, you can count the unborn child as a child dependent on your income-driven application. You can't obviously on your tax return. Another example is any people who are living with you, like let's say your parents are living with you and they make less income, or you account for greater than 50% of the household, you can count them. If your best friend's on the basement and the couch for over 180 days and you're supporting them by over 50%, you can count them as other dependents. Well, those will lower your payments. So let's say you make 90,000 a year, and you go, force 3 or 4 of your friends to move in with you, and you support them greater than 50% of their cost of living in the household. Then you might have a family size of 4. Now you say 90,000 minus family size 4, which is 46,000 in IBR is 6,000 times 15% is about 8,000 divided by 12 is payment of $700 a month. You might be able to squeeze in at $600, $700 a month below the threshold there, depending on what your original balance was. But it's going to be difficult for you to get into IBR. So for you, I would say stay in the pay as you earn for now, unless you think you can get into IBR you don't have enough dependents right now to even check on that. But that's an example of where you could do that. But for you, because you're so far, your income right now, your proof of income, even for last year was 90 grand, right?
Yes.
Okay, so yeah, so you don't have, you don't really have a way of getting into IBR unless you make less money. So you might as well
So
stay
am
where
I
you're at.
not eligible for any payment plan?
Yeah,
Am I gonna
if
be just
all of,
kicked off?
if the worst case, in the worst case scenario, if the courts cancel all 4 plans, ICR, pay as you earn, revise pay as you earn and save, then you do not qualify. That's one of those circumstances where you don't qualify for a plan. Now, as I said before, I'm expecting a solution to that. They can't just leave these people hanging, right? Like yourself, right? You know, what if you're at 100, I have people at 115 qualified payments who technically can't get into a plan if they cancel everything. There's got to be a solution for them. Maybe, you know, they can get you into the new, you know, Republican plan that they're using, something like that. But you want to avoid that if you can. But in your case, Christine, I don't think you can. I think that you're gonna you have to wait for an alternate solution that see if they allow you to get in a different plan that solves that problem. But you're in those one of those rare, not so rare, unfortunately, circumstances where you have no recourse. If they get rid of pay as you earn, advise, pay as you earn, save, and ICR, all 4 of them, then you can't get into old IBR because you make too much money. And as a
But
result, you don't
currently
have
I'm
a qualifying
eligible
month.
for all of those payment plans.
You're not eligible for new IBR. Your
Mhm.
loans are after, do you have any loans prior to 2008? Well, you do because you're in pay as you earn,
No.
so you don't.
Yes,
Yeah,
after
yes, yeah.
2008.
Yeah, so they're after 2008. So pay as you earn survives, you're fine. If some version of repay or save survives, which is almost impossible, then you're fine. Or if you have, how many qualified payments do you think you have left before forgiveness?
I'm at the halfway mark.
Yeah, so income contingent repayment would still be such a high payment that even if that program survived, that formula would be 90,000 minus 15,000, which is 75,000 times 20%, which is 15,000 divided by 12. Your payment would still be like $1,200 a month. It would still pay the loan off in 5 years or less. So even if income contingent repayment survives, you're not going to have anything left to forgive. It'll create a qualified payment, but it'll be high enough to pay the loan off before you receive any forgiveness. And you don't qualify to get into IBR at all because you make too much money, and pay as you earn or buys, pay as you earn and save will be gone. So they're really, as it, you know, based on the current situation, there'll be no plan remaining for you, unfortunately.
Now,
Mm.
Jan,
I wish
just,
I had a solution for you, and hopefully there's one that presents itself, but go ahead.
just for something more immediate, so if someone's already in save and they're eligible for forgiveness this year, like August, so do you say they write it and then do the buyback? What would be the best?
Well,
Or
so
do
yeah,
they,
so
do
try
they
for the
get into
buyback.
IBR?
Yeah, do both. Put in the request to switch to IBR as soon as possible, and then also once your buyback months will count or equal 120 with your other payments, then you can call or apply for buyback as well. So as an example, let's say you have 115 qualified payments. You've been in the save injunction forbearance for 7, 8, 9 months now, whatever it is. Some people 10 months, and you're in the save injunction, not getting credit. You haven't been forgiven yet. So first thing, do an employment certification form. Second thing, apply for buyback. Third thing, switch to IBR as soon as you can in case IBR doesn't work. Or in case buyback doesn't work.
Only because because I'm thinking okay, let's say if I'm eligible for forgiveness in August and it's taking them 8 months to process, does it really, but they should still do it, is what you're saying?
Still do it because
Okay.
they may have to eventually go into
Okay.
another plan to finish out those 5 months. So your likelihood of getting into IBR speeds up, potentially is faster by submitting the request instead of just waiting until they force you. Because who knows how long the injunction will last.
I have about $25,000 in student loans. I'm currently on the SAVE plan. I've not made any payments. My application for SAVE was processed in 2023. And right now, I am, although self-employed, I have no income. So basically, I am not making any money right now. My question is, 3 of my loans, one of the subsidized ones, sorry, 2 of the subsidized ones and one of the unsubsidized one says that the repayment begins August 30th of 2025. Now, how will I navigate this going forward? Will they use my 2024 taxes? Or how is that going to work for me?
And you're in the save forbearance now, right?
Correct.
Okay,
Yes.
so I got good news for you. All right, so this is going to surprise you. You don't have to do anything. So the reason why it shows payments are due in August is because the waiting on administrative forbearance only lasts 3 months at a time. So if you've noticed, if you checked it in July, it said it was due August of 24. If you checked it in August, it says it's due in January, right? So they keep pushing it forward. That's going to continue to be pushed forward until the courts decide on the SAVE program and they force you into something else.
Gotcha. Okay. So, and then what you're talking, when you were saying to get into the IBR, you were giving a lot of others that advice. What would you say for me?
For you, when you're not working, stay and save. Yeah, enjoy the 0%, zero interest rate, zero payment. And when they make you if they make you switch, if you're still unemployed, then you can just switch using your unemployment status, and it'll be $0 in whatever plan that is.
Okay.
So unemployment is a $0 payment in any plan.
Okay.
So yeah, any income that's below the hardship threshold or the poverty line is going to create a zero payment.
Okay. Thank you so much.
You're welcome. Do we get everybody?
And,
Do
well,
do you
we're
have
at
a
1:20, so I'll say we'll do a stop at 1:30, but so I'll
Yeah,
10 more
if someone
minutes.
else, I think I heard somebody say something. Does
yeah,
somebody have a
do you
question?
have a good website for us to calculate a payment based on the IBR before we switch over? I tried using the student aid one, and then it's calculating it based on SAVE, which is kind of useless at this point.
They're all kind of junky. I mean, you're single, so it's easier. I would just put it into the formula, honestly. Again, your adjusted gross income on your prior year tax return, which is line 11 on the 1040. You subtract for the IBR plan, subtract 150% of the poverty line in your state, which is about 23,000. Take that times 15% divided by 12. That's what your payment is. That simple. Luckily you're single, so that question is a lot more simple.
Is that formula online somewhere?
Yeah, somewhere. It's at student aid somewhere too,
Okay.
if you can find it. But you want me to put it in the chat for you?
That would be great. Thank you so much.
Yeah, sure.
And if you
Go
have
ahead.
if you have dependents, is it similar or does it change significantly?
Right, so that increases the family size and then the poverty line. So, for example, 150% of family size 2 is 29,000. 4 is 46,000, and so forth. So it goes up like $6,000 per child. So for every dependent you have, it's gonna, lower your payment in IBR like $75 a month.
I am I'm not in PSLF. I was just planning on doing like the 20 or 25 years forgiveness thing. But that is almost certainly going to go away. I might as well just start dealing with a 10-year situation, right?
What year did you first take out your loans?
I originally had loans before 2014, but then they all went away. So as of 2014,
as of July 1st, 2014, you didn't have any debt?
no.
So you qualify for new IBR, and the IBR program is not going away. And you'll qualify for the 20-year forgiveness under IBR for sure.
Do you think, I mean, everything just feels so tenuous. Do you think it'll happen?
That program is Congress approved grandfathered law that's
Really?
Unambiguous. That there's no plan to cancel that forgiveness. There's no lawsuits against it, and it's ironclad. I mean, it's it's not. See, the other plans that are in jeopardy, the other 4, ICR pays one advice, those were based off of executive actions. They're based off of the original ICR statute from 1993, which is ambiguous, doesn't quite come out right out and say there's forgiveness. And so those programs could all be wiped out, but IBR, which for you is great because it's the same as pay as you earn, it's the 10% formula, right?
Yeah.
So like a $50,000 income in IBR for you is only be $200 a month, right? So that program is going to be there. It can be relied upon. It's as reliable as PSLF. Yeah.
Okay, good. And then is there a way to like verify, like, does the government keep track of when, I guess I'll just process my application and then they'll verify the that I'm eligible for it. So I could do that now. I'm in like forbearance, just I was trying to switch to save.
You're just in a
during that.
regular forbearance, right?
I'm regular because my application I got like thrown into limbo
Right.
last summer.
Who's your loan servicer?
Nelnet.
Nelnet is. So when you go to Nelnet, if you look under a payment plan, it says level or, just so regular payment, then you would do an application. Go to studentaid.gov.
Okay.
When you're in studentaid.gov, hover your mouse over the loan repayment tab and then click on income driven plans and then click apply. And then go through that application, have your IRS form 1040 or your W-2, have it uploaded as a separate file on your computer. So when it goes to upload it, you can grab it right off your computer, upload it into the system, submit it right there, and then you'll have it on file and eventually be approved for that.
And I should look for new IBR.
You just have to apply for IBR. That's it.
Okay.
Your
Thank you.
your date determines whether this is the 10 or 15%. So they'll be able to see you didn't have debt in July 1st. There's something called a borrower flag on a technical level for these loan servicers, so that it's not a guessing game. It'll say, the borrower flag will say new borrower or old borrower. They'll know and put you in the correct plan.
Great. Okay. Thank you. That's great new information for me. Thank you.
You're
Jen,
welcome.
sorry
No problem.
to,
What about like the same question as Kate, but for someone who would be an old IBR? I know you keep saying to move over to IBR, but what if you're just, banking on that 20-25 year forgiveness and you're really not in a hurry to pay substantially more? Like, is that okay to just kind of hold steady in like
if you're in
pay?
save, you mean?
Yeah.
Yeah, if you're in save, sure. That's a great example. So some people, because see, I have what I see, Alyssa, on a normal basis is, Jan, I work for this nonprofit. I can't work another day at this stupid place. I want to get this darn thing forgiven. I'll pay $10,000. I don't care what I have to do. If I have to rob a bank, right? Other people like yourself are like, well, I'm enjoying the $0, zero interest or not accruing interest. I've got other financial objectives. I'm in no hurry. I'm not doing PSLF. Sure, stay in it, ride it out for as long as there's nothing wrong with that. It's not really hurting you. And in fact, you could take, instead of paying on that loan, you could take that money and put it in a money market account and get 5% back on it while you're getting 0% interest rate on your loan. So there are circumstances where it makes sense for people just to stay where they're at. But for people really pursuing, especially PSLF, or if they're really close to the end, like let's say you were 20 years into the income driven plans, you only have like 3, 4, 5 years left before you hit the 25, then there might be more of an impetus to get switch to a plan that brings you to that goal. But if you still have 20 years left, there's no hurry. Your income growth isn't going to dramatically increase in the coming years. Nothing wrong with staying with your app.
Got it. Thank you.
Hey, Jan, you know what? I'm a knucklehead. So this will bug me, so I need to ask again what I mentioned earlier. So basically, the individuals is in save, okay, and eligible for PSLF August 2026. I'm already thinking we're in 2026.
Yeah.
Should they still switch to the IB? Should they still apply for the IBR, even though it's a year away, because with all of the uncertainty with save? Is that what?
Well, see, if they're in the save injunction, right? Then the anniversary date is more tenuous because, there's a new sheriff in town, people, and her name is Linda McMahon. So we've got the WWE running student loans now. So if the courts come back and say save's canceled, I doubt you're going to be able to wait until 26 to recertify. I think they're going to probably they may make you recertify. So have your proof of income in order for people in the save injunction. And so you might as well switch now if you can. Again, you don't have to, but I know that, you're not getting credit right now, right? So yes, your anniversary date isn't until 2026, but you're not getting credit. So if you don't mind not getting credit or enjoying the $0, not in a hurry for forgiveness, your income growth isn't that dramatic coming up, stay where you're at if you want and wait till they force you change, but you're not getting credit right now. So if you have more of a desire to make progress towards forgiveness and you want to expedite that process, then you want to switch as soon as possible so you can start getting real-time credit for qualified payments.
Hey, Jan, this is Jeff Tonkovic again. You kept mentioning every now and then about ICR going away. And as you know, Effie and I, since we consolidated the Parent Plus loans for PSLF, ICR was our only repayment option at the time. So if ICR goes away, what happens?
So that's a good question. We'll have to, there should be another solution, but I don't know what that is. So I don't want to scare you right off the top, because I think what will likely happen is that the ICR individual forgiveness, the 25-year forgiveness of ICR will be canceled, but they'll probably keep the ICR program as a qualified payment towards PSLF. So you'll still be able to use it, get the 10-year most likely. That's what I'm hopeful. I don't know that for sure, but that's the likely solution.
Now, another question I put on here, and you didn't address it. Maybe some other people have concerns, but when you recertify then for the PSLF every year, with your employer, the Biden administration was very grateful and made my wife's employment, eligible. So she's not in a 503C, it's a 506C or something, but it's still non-for-profit. And
that's still so that still qualifies though, even under the original statutes. So you can work at a 501c6 and as long as it meets certain criteria, right? So for example, if you work for a 501c3, I don't care if you're the janitor or what you do or what company you work for. If it's a nonprofit or government agency, you qualified, hands down, no questions asked. If it's a 50c6, that type of thing, not for profit or something like that, then if you notice, even on the form, it lists like 14 different, you have to be even emergency medical professional or for childhood education or stuff like, you have to meet those criteria. But if you meet those criteria, then that'll still qualify and they won't take that away from you. There are rules on PSLF that were instituted during the Biden administration that weren't in the original statute. The one that you mentioned was, so you're safe. But like, for example, the rule that allows you to work part-time 30 hours a week or more, that could be eliminated theoretically. And you would then have to be considered a full-time employee.
More full-time, we're good. Yeah.
So you're good on that. I just want to mention there are things that could be taken away, but that's not one of them.
I just wanted to ask about servicers. You had mentioned the differences between Nelnet and Mohila. When you're transferring over to IBR or you're transferring over to a new plan, is it possible to choose a new servicer? And is there something that you would like? Is there one that you would recommend going to?
So you can't choose the new servicer. Sometimes they transfer you without asking you. But if you do the only time you can choose your servicer is during a federal student loan consolidation. So let's say you have more than 2 loans, because if you have a federal direct sub and unsub consolidation, you can't reconsolidate it. But if you have a federal direct consolidation and 1 Stafford loan, you can consolidate those 3, and in so doing, choose a different loan servicer. I would recommend Aidvantage. I work with these servicers on a daily basis. Mohila is a mess. Mohila should be set on fire. I mean, it's just
I drew them.
Unbelievable. Yeah, just awful. No, I don't mean that literally.
No, they're awful. That's okay.
They're terrible. In comparison, it's just unbelievable, especially as of July of last year when they switched platforms and it went to mohila.studentaid.gov. They don't process paper forms for forbearance. They don't answer their phone. They don't call you back. There's a 5-hour hold. It's a nightmare with Mohila. So for all you Mohila people, you have my sympathies.
Actually, I would say this though. I think I'm among the lucky ones because so far, fingers crossed, it's been good. But I've just heard, and of course I'm thinking because I selected them, I'm thinking, oh, thank goodness. But yes, but they've been
right. If you haven't had to do anything or deal with that, then deal with them. Then you're
I'm lucky. Yeah.
Don't poke the bear.
I'm on the chat box. I'm suggesting some of these loan simulators, loan calculators. So feel free to chime in if this is helpful at all. And there you go. Just to there you go.
Looks like we got a ton of messages. I probably won't be able to get to all of them, but
Jan, can I ask a quick question?
Yeah, go ahead.
So I have a call scheduled for you, so I won't go too into detail. But I am PSLF and on the SAVE plan, so I understand I should be switching to IBR. My question is, should I wait to file my taxes until I can switch to IBR, or does that not matter?
If your 23 return is lower, absolutely.
Okay.
So you want to,
I was going to say it's just lower by like cost of living increase, so it's not significantly lower, but I should wait.
How much lower? Is it like 5,000 lower, or how much lower is it?
Yeah, it's like 3,000 lower.
Okay, so that's only going to be a $25 a month lower payment. So it's not going to make that big of a difference. But if you want to wait, why not? The other reason to wait is that way you can use 24 next year, right? So you can be one more year in the lag. So if you ever do have an increase in income, it won't impact, let's say you start making 20,000 more a year, that won't impact you until another year into the future. So it's always good to be in the lag with the tax returns if you can. Even some people, as I mentioned before, with one of the other borrowers, where she was doing a full extension on her taxes to October 15th. Sometimes that's a good idea, just so that you can use your prior year tax return even after April 15th of this year.
Can I ask a follow-up question?
Yes, go ahead.
So I think that I was on the repay or the pay plan
Right.
before I switched to the save, and I had about maybe like a year of 0 payments. Will those be
Those
switched?
count.
Those will count just
Yep.
automatically.
Yep.
Clarification on this, there's this last item that came in.
Mhm.
So if they switch to income driven from pay, does that take them from a 10-year plan to a 25-year plan? So if pay goes away, they're adding 15 years to the plan before forgiveness? Is that what's
No, so
happening?
pay as you earn is a 20-year plan.
Okay, 20-year, okay.
Yeah, exactly. Public service loan forgiveness is 10 years, no matter which plan you're in, right? So if you switch from pay as you earn to IBR, you're going from a 20 to a 25. You're adding 5 years.
I am under the public student loan forgiveness program. So if I'm
Okay.
in that program and I switch from pay to income driven, it shouldn't affect the 10-year
No,
timeline.
no, you'll
Okay.
keep the credit you've already gotten, and you'll continue to accrue qualified payments until you're forgiven. Your payment just might be a little higher.
Are you still allowed to submit pay stubs versus tax form? I filed married filing
Yeah.
separately, but in Texas, it's community property, so my taxes show
That's right.
higher income.
Great example. So let's answer the community property question. So when you, just for those who don't know, if you live in a community property state, like mostly the West Coast or Texas, the California is a big example. Let's say one spouse makes $100,000 a year and the other spouse makes $200,000 a year. Well, when you file separately in most states, in about 38 to the continental United States, you can only use your income, and you'll get, let's say you're the spouse who makes 100,000, your AGI will show about $100,000 on your tax return, and your payment will be based off of that. But if you live in a common property state, they'll take your combined income between your spouse and split it equally between the two of you. Say actually in this circumstance, you make 200,000 and your spouse, the borrower makes 200,000 and the spouse makes 100,000, right? So when they file separately in the state of Texas, their AGI will show 150, not 200. So it actually makes your income look lower, right? Or if they make 100,000 and the other spouse makes 200,000, then their income still will show 150 on the separate return. So if your tax return in a common property state is higher than what your actual income is because of that, then you can use alternate proof of income documentation. You can still do that. So when you're filling out the application, it's going to ask you, are you married? Yes. You file jointly? Yes. Or no, you file separately. Do you have reasonable access to your spouse's income? Yes. And then it's going to ask you, has your income changed or decreased since your prior tax return? Yes, it has. Your income is different than what the tax return shows. And that will prompt the system ask for alternate proof of income. Do you have taxable income? Yes. Then you will upload your W-2 or your paycheck stub or whatever, and then your payment will be based off of your individual income and not your tax return, which shows the half of the combined. So again, I'll just repeat it one more time. Spouse one makes, the spouse with loans makes 100,000. Their spouse makes 200,000, right? The borrower's spouse makes 200,000. If you file separately, your AGI shows 150 in common property states, California, Texas. But you don't make 150. Well, that's not fair. Well, there's a way around that. You go ahead and file separately. You go ahead and create your $150,000 adjusted gross income, but then you say that your income has changed and provide alternate proof of income that shows only your individual income. And that's completely within compliance.
So do you know if the IDR, the one-time adjustment, if all the counts are in? Because I have no way of accessing that on my student aid page, and everything's grayed out.
I know. So some people, about 1 out of every 10 people I talk to, something doesn't populate on studentaid.gov. And when it's working correctly, right, a green box populates and shows the results of the one-time account adjustment and so forth, right? But when it's not, you can't see it, it doesn't show. And then people who've recently consolidated or double consolidations are other examples of where it's not yet tallied yet.
We applied for the SAVE in 2023, and I just don't know if I'm in that program or if I'm not in that program because it says it's in review. So I don't even know what plan I'm in.
Oh, you don't know which program you're in? Well, who's your loan servicer?
Nelnet.
So when you log into Nelnet, click on the My Loans, the top left in the menu bar, and then look for, it'll tell you repayment plan. And it'll either say saving on a valuable education, or it'll say level, or it'll say IBR. It'll tell you which plan you're in. And then you can look at the status too, and it'll say forbearance, or it'll say in repayment. You can see where your plan is. You'll find out if you're in it there.
I guess the reason why I'm asking is because when you go to the student aid page, it says in review, but then when I went into Nelnet, it said SAVE. So am I in it or am I not in it?
So yeah, so let me tell you something about studentaid.gov. With the exception of PSLF, all the data they get on real-time data from the loans comes from the loan servicer directly. So if it doesn't, always trust your loan servicer over what studentaid.gov says. Never call the student aid information desk for anything except for a password reset. Maybe the dumbest people on the planet, the most worthless department of all time are the studentaid.gov. They will try and answer questions that they have no business answering, that they have no idea what the answer is. The stuff that I hear from them, I mean, your loan servicer is bad enough. I get it. 2 out of 5 answers are right from your loan servicer. 1 out of 300,000 are going to be correct from studentaid.gov. Unless it's a password reset, they can answer. They can do that. They can maybe tie their shoes on Wednesdays, but if they try and tell you something about anything to do with policy or your loans, even if it's on studentaid.gov. Like you can ask them, well, why is it showing this on studentaid.gov? Whatever they tell you is going to be wrong. I bet my life on it. They're worthless. Perfect. I'm glad this worked out so well. I think people asked great questions, and as I knew they would. And I think we hit all the major points that we needed to, given the state of things right now.
All right. Well, everyone, thank you again so much, and best of luck. And Jen, I'll be reaching out to you, Jen. I have through my Gmail, because my Gmail is blocking my company email address. So there you go.
Whatever it takes.
So let me give them a plug. Public Policy Exchange. So on behalf of Public Policy Exchange, thank you, Jen. Thank you, everyone, for for this for your participation. And we look forward. I do definitely look forward to our next webinar, and I'll be touching base with you.
Me too. My pleasure. All right. Have a great weekend, everybody.